So, Asher, I think, you and I have had a lot of analyst calls today. What are sort of some of the key takeaways that you want our investors to know about sort of how this time it's different, and how, what are your sort of three top priorities, day one as new CEO?
Thanks, Sue, and appreciate everyone spending the time today to listen. And I appreciate the opportunity and the privilege to lead this business and to return value to shareholders. When I think about the business and the opportunities and the issues we need to fix today, I segment them into three frameworks of thinking and three goals. The first is maintaining a strong balance sheet going into the halving. And so I'm a believer that Bitcoin isn't going to double overnight and it's going to get worse before it gets better. And we've really uh, understood and made investments and purchased assets during kind of the bear cycle over 2022 and 23. And so we will continue to look at opportunities post halving where we can deploy capital off of our balance sheet in order to return investments. So having that strong balance sheet is extremely critical to drive growth. And we want to go into the halving with a strong balance sheet. Today, we're about 9,200 Bitcoin. That's almost $400 million. And that's really important to maintain a strong balance sheet. Simultaneously, though, we have to look at opportunities to grow the business. And when we look at opportunities where we can invest capital and have strong return profiles on that capital, we will invest in a risk adjusted way in order to continue to stay competitive within the industry. So, looking at areas that we can invest capital that we believe has a strong NPV and IRRs on those investments. And then lastly, and I would say most importantly, as the first two, is we need to strengthen the core business. The idea of US Bitcoin and Hut 8 merging was Hut 8 had a strong balance sheet. They had a diversified strategy that they were starting to implement, and they were publicly listed. On the US Bitcoin side, we had large scale operations over 730 megawatts. I think one of the largest miners, if not in the country, in the world in terms of operations. And what they brought to us at the time of the merger was a strong balance sheet and access to the capital markets to be able to drive our cost of capital down in order to invest and grow. And what we brought to the equation was operational efficiency, prowess, and the ability to execute. And so our board of directors, after having merged for the last 2 months, decided that the business needed to go into a direction where we focused on being a low cost operator that could scale and that can drive confidence amongst our shareholder base. And so the three goals are maintain a strong balance sheet, invest capital thoughtfully for growth and strong returns, and really fix our current business and the inefficiencies that we have. I think naturally, as companies grow and scale, inefficiencies naturally accumulate. So I'm going to take a fresh lens and a fresh eye to look at every single business line we have, every facility we have, every cost center, all of our SG&A line items, and take a methodical and rigorous approach to figuring out how we increase efficiencies, focus on margin expansion, and increase profitability.
I think, okay, that's great, Asher. I think also I'd love for you to share some of the stuff we talked about, how you're thinking differently in terms of how we grow. Obviously, the entire sort of mining equities universe has been super reliant on, like, let's call a spade, dilutive sources of funding. And so would love for you to share with the audience sort of like, how do you look at, having come from a private company background, how do you look at growth, and what is your sensitivity to sort of dilution and as a strategy?
Yeah, no. So there's sources of funds and uses of funds, right? And so sources of funds, I think there's five different levers in which we can pull capital in order to invest. We can pull capital in the equity markets. I believe our cost of equity is extremely expensive right now, especially due to recent events. We can pull debt from parent level debt. I think pulling in debt going into the halving is also extremely risky and something we're not interested in today. We can pull project level financing, which is in people investing on the project level of facilities investments that we do. I think it's a really interesting opportunity for investors to come in and not take platform exposure and to get pure site level return profiles. And it gives us a way to grow in an anti dilutive way. The fourth is we can look at the balance sheet that we have today and the Bitcoin that we have. And then the fifth is we can look at leveraging that balance sheet and playing in different option strategies depending on what opportunities are in the market at that time, where we can maintain the upside optionality of our HODL strategy, protect against the downside of lending against it, but being able to pull working capital. So at every moment in time, it's really assessing those five levers and figuring out what is our lowest cost of capital and our lowest cost of risk adjusted capital, right? And that's really important because I'm a big shareholder of this company. Mike, the chief strategy officer, is a big shareholder of this company. Like, the value that I gain in running this business is the shares of this company going up. And candidly, my net worth dropped in half this last month. And so I'm extremely motivated to go and build and grow this business and bring confidence back into the market and under promise and over deliver. I think our job as a high capex infrastructure business is to focus on how do we invest money that has a strong return profile and beats the index over a long period of time. And investors will have confidence in us in being good allocators of capital. And I think the biggest issues that have existed within our sector is companies have grown, they've added exahash, they've added market cap, but at the expense of shareholders and shareholder dilution. And one great book that I read that's really kind of honed in on me and has framed my approach in this new seat today and in this tenure is, I implore everyone to do this exercise. It's fascinating. So there's a book called The Outliers, and it talks about a subset of CEOs that have outperformed the market over the last 100 years. And the one metric that they use to kind of keep everyone apples to apples is when you invested a dollar, if you invested a dollar when the CEO took over until they retired, how much does your dollar become? So I did that same analysis for our sector. And I said, okay, if I invested a dollar in January of 21 when we started our company, we started in December of 2020, to be fair, how much would that dollar have become if you invested in our private company at the time versus all the mining companies versus the S&P 500 versus Bitcoin? And the results were astounding. There are many companies that grew massively in market cap, 5, 10x bump in market cap. However, you lost money as a shareholder because of the dilution that existed. And so I think the alignment that we have as management to shareholder value creation, and the goal is not to be the biggest, the goal is not to have the largest market cap. The whole goal is to invest money to drive shareholder return and shareholder value creation, and by doing so, I believe that you'll be able to be the largest and best because people will trust you with their capital.
Yeah, yeah. Okay, let's actually take a couple questions from the audience. Simon Dixon, you are up.
Oh, thanks for having me up, Sue and Asher.
How you doing? Good to see you again.
Yeah, good to see you again, Asher. Been a bit of a journey, hey?
Yeah, it has indeed.
Uh,
And
my
maybe,
question. Oh, go for
sorry,
it, Sue.
really quick, Simon, maybe for those in the audience who might not know you, maybe you could do a brief introduction of yourself.
Sure. Yeah, I've been involved in Bitcoin since 2011, and I was one of the largest creditors in Celsius. So I'm soon to be a shareholder in Ionic Digital, which I believe is one of the contracts that Hut 8 is going to be managing. So that's my background. Question I had is there anything you could update us on the progress of the contracts with regards to Cedarvale? It's a bit of a tangled web, so I'll try and explain it, and maybe you could explain it. But Hut 8 will have a management contract with Ionic Digital. Ionic Digital is the new public company that comes from the Celsius bankruptcy. And we got approximately 122,000 ASICs we're looking to deploy. So I'd love to get any updates you could share on when you think those might be live. And I understand you got like penalties and stuff for not getting them up on time.
Yeah,
Any
definitely.
updates you could give, that would be great.
Yeah,
Thank
sure.
you.
And to your point exactly is we have a lot of confidence in our ability to execute. So to your point, we've had basically milestones and benchmarks set. I think the one sensitivity, Simon, is since Ionic is now public and there's non-material public information, I'm going to be sensitive in sharing kind of the information has already come out and then leave it to the Ionic team to share updates as they see fit. But the site is underway. It's already in construction phase. And The goal is to get all the miners plugged in. It's two phases: a 40 megawatt phase one, and then there's a 215 megawatt phase two. Both sides are underway and in construction, and miners will be coming online. I just can't share timing until Ionic does. It's their site, it's their news to share. But we're working hard, and we're excited by the progress.
Asher, maybe you can really quickly, for those in the audience who maybe aren't following it, like where does Celsius sit in our entire portfolio? And maybe if you could walk through sort of Hut 8's portfolio of businesses, like when you talk about the different SG&As and P&Ls that you're going to be evaluating and effectively, trimming the fat or doubling down on. Can you just give a high level overview of those different pieces of our portfolio?
Sure. So I would kind of categorize it in subsets. At our core, the way that I think about our business is our business is in the business of monetizing electrons. And today, Bitcoin mining for stranded energy, we believe, is one of the highest use cases of monetizing electrons at scale. And I can go into that a little bit deeper as well if people are interested. But just sticking on to Sue's question is today we have a couple of business units. We have the Bitcoin mining business unit. We have the HPC data center cloud business unit. And then we have a portfolio of power plants that we have announced that we're still in the process of closing on the Validus assets. So those are the kind of three categories of diverse kind of electron arbitration. In regards to Bitcoin mining, those are also split into three different kind of revenue streams. The first revenue stream is self-mining, where we have machines and we mine Bitcoin. The second revenue stream is hosting, where we host third parties on our facilities and they pay us a fee. And the third business stream is managed services. So when I break those three out and why did we diversify is we believe that scale begets scale, and to have like the Costco model with economies of scale, we can drive our costs down, we can have more purchasing power, and that's better for us and our partners. And so when you look at the Bitcoin mining, self-mining part of the business, it's higher CapEx. We have to invest in infrastructure and we have to invest in miners, which are, depending on the timing in the market, could be upwards of 60, 70, 80% of the overall cost of upfront CapEx. So that business vertical is higher CapEx, higher upside in return, and higher downside depending on hash prices and the swings in volatility. The second business vertical is hosting. So I would call that kind of medium to lower CapEx, where we have to invest in infrastructure and then we have customers come and co-locate their machines with us. And there's a couple different models that we have. We have models where they just pay us a fixed lease rate. We have profit share models. We get a percentage of the profits. We have hash price models where we get paid differently depending on hash prices. And so I think that model is really interesting because we have lower CapEx needs up front. And depending on how we structure kind of our risk profile on payments, we can sacrifice some certainty of cash flows for upside based on Bitcoin volatility. And then the last vertical is managed services. So we started operating these facilities at scale. We built our own proprietary technology. We have all of these SOPs. And we said, hey, we're really good at doing this. What if we offer this as a service offering? If you look at kind of traditional businesses, like Halliburton is a big publicly traded company. They manage a bunch of oil and gas assets. And and the thought process was this business doesn't have an institutional operator that institutions can hire to run their Bitcoin mining operations for them, whether that be Bitcoin mining companies who just want to invest in owning some Bitcoin mining assets, energy companies who want to have these behind the meter, and so forth. And so that's how we built that business unit. And so the way we think about that business unit is it is a low to zero capex business. We take the business and the kind of scale and the technology and the IP we've developed. We operate sites on behalf of third parties. We have a fixed revenue stream on a cost per megawatt per month, and then pass through on kind of the cost basis to the end user and the end customer. And for us, it's a stable source of revenue stream that gives us scale in order to drive continued economies of scale across the business and to our partners. And the goal is we make money by having a stable revenue stream that manages through volatility. And for our customers, ideally, we're so efficient that by choosing us, even with our fee, it is more cost effective than that if they were to do it themselves.
I think also, and I think a lot of you guys have probably heard me talk about this on YouTubes and podcasts and whatever. If you look at the two new entrants coming into the Bitcoin mining space, renewable energy providers and oil and gas, adding Bitcoin to their balance sheet is like a rounding error, okay? But it's the ability for Bitcoin miners to be that flexible load balancing solution that renewable energy providers need. And then also for oil and gas, it's that ability for Bitcoin miners to help with methane mitigation objectives. And we like, look, we're not saying we have methane mitigation technology, but we are saying that we are that enterprise partner that if an oil and gas company says, "Hey, I want to, yeah, invest in this infrastructure to meet, my methane mitigation goals and not, get fined for flaring gas, etc." We are that go-to partner. That is something that, again, like Asher mentioned, Halliburton does, and they've just effectively copied that business model for the mining infrastructure industry. And then I think if you look at 3 to 5 years, there's something like 26 gigawatts of renewable power that's coming on in the U.S. alone in the next 3 to 5 years. And so that's a huge potential total addressable market for this managed services business arm of Hut 8. Anyhow, so I'm going on a bit of a tangent, but thank you for that, Asher. I just wanted you to give the overview for the audience here. Are there any more questions for Asher? There's almost 400 of you on this call, and now's your time to sort of put Asher in the hot seat here. Okay, there doesn't seem to be any questions at this time. Yeah, Asher, any sort of closing thoughts before we? Oh wait, hold on. We've got some requests come in here. Hold on. Okay. Okay, we have Salih. Hi, Salih. We haven't talked in so long. Great to
Yeah.
see you again.
Hi, Sue. Just a quick one. I think we have discussed this before. This company have rebranded itself to Hut Corp. Um, the question is, how relevant is mining to Hut 8 going forward? Because the more expansion into data centers, power facility, and being a power play is deviating the company from its core essence that started initially as uh, a Bitcoin miner. There was an expansion on data centers, on HPC, on all kind of things aside from mining fleets, capacities of miners. With the outlook of the competitors on the mining space going in on exahash over 2030 with plans to expand toward the halving, which is driving the cyclic view of the market. How would you see that business line of mining and its imperative and importance toward the company going forward?
Thank you. I appreciate that question. So I think in order to answer that question, I can talk a little bit about our vision, the type of business we believe in. I think it'll lean into the question you just asked. We believe that our business is in the business of monetizing electrons. The directional bet that we're taking is if you look at a lot of kind of energy dynamics today, I'll use the US for example. In the US, you have a lot of renewable power being built in places like West Texas because of tax subsidies in the IRA, and you have all this wind and solar generation being used. We kind of coined this term stranded energy, right? You have this energy being created, you don't have consumption, and transmission lines are going to take 10 years, 20 years to go and build because of the amount of kind of easements you need to get and governments building these. And so you have all this power that's there that isn't getting used, that is getting curtailed. You have negative energy rates at times and can't get transferred to places that want to use it. And so the directional bet that we're taking is we believe over time, there are two things that will happen. More and more transmission infrastructure will be built to transfer that energy from where it's being produced to where it needs to be consumed. And then there will be more use cases for that energy in order to drive economics and return. And so today, based on all the analysis that we've done, we believe that Bitcoin mining is one of the highest and best uses of power in terms of return profiles in regards to that type of energy, right? And in the Middle East, for example, you have interesting power dynamics where aside from kind of the 4 summer months, you have the other 8 months, where you have kind of 50% utilization. You have all this power that's excess that you can use in order to mine Bitcoin and other use cases as well. And so when we look at kind of what use cases could there be for these electricities that generate a return, you have Bitcoin mining, which is our core business today. You have data centers and AI, and there's different dynamics there because you don't have 300 megawatt AI data centers. The cost of CapEx is a lot more expensive. You're spending $40 million for a megawatt and a half of servers. You're spending $8 to $10 million for every megawatt on the AI side, where Bitcoin mining, you're spending like $300,000 for the infrastructure, and you're spending, call it 500,000 to $1 million per megawatt from the infrastructure, depending on kind of the time in the market. And so as the market continues to expand, we see use cases like Bitcoin mining, data centers, battery technology, I believe, is continuing to improve and catch up. Today, without kind of the tax credits, I still think it's hard to compete against Bitcoin mining. You have longer data technologies like green hydrogen. You have carbon capture. In our analysis that we've done today, our belief is that technology isn't here to be commercialized yet. There needs to be improvement in technologies. Costs need to come down. Transportation costs on ammonia for green hydrogen needs to come down. And the reason I say all of this is our directional bet is let's take as much power as we can, build out Bitcoin mining, which is the highest and best use of that power, but be good stewards of capital and always be open to saying, okay, I consume this electron. What is the best use case for this electron that generates the best return to our shareholders? And then with that return, we can decide what's the best way to distribute that return to our shareholders. And so to answer your question, we do believe that Bitcoin mining continues to be a really attractive investment where we can get a strong return profile. I think our thesis is a little bit different. We don't believe that you need to have the largest exahash or the largest market cap. I think what you need to focus on is return to shareholder value. You have to think about what is my cost of capital? If I'm raising equity, what is that cost of that equity? And can I make sure that the investment I have returns more value than the cost of equity itself? I think our industry has had a ton of dilution, and the dilution, even though you've had great growth, as a shareholder, you haven't made much money. And so our focus is on how we return shareholder value by making the right investment decisions. And I think continuing to have scale is important to be competitive, to have a good return profile in the business.
Nice. Thanks, Asher. Okay, we're running a little low on time, but I want to let Bommy Investor speak. And then, guys, I think we're probably going to do this like maybe every week, maybe every other week. But Bommy Investor,
And I think one thing that
your
I
turn.
told Sue, just to kind of be open and transparent with everyone, I'm going to be spending less time than kind of how leadership has historically speaking to investors in the street, and spend a lot more time focusing on building the business. However, I will continue to do these, and I'm going to have other folks in our team do this as well, because the brand that we're building is not based on me. It's based on the amazing talented individuals that we have on
Yeah.
this company. And so we'll give exposure to everyone and the depth of that talent and the depth of those experiences.
Yeah, also like just as a quick example, and then Bommy, I definitely want you to talk. As a quick example, there's guys on the energy team like Riley Tritell, Chris Vickery. Like there's some real subject matter experts that we now have that I think, we'll be able to go even deeper with you guys. And to Asher's point, like there's a huge team behind him that's driving these what we think is going to be incredible growth strategy. But yeah, so Bommy, you're up next.
Awesome. Thanks, Sue. Yeah, so my question, I guess, is for a lot of shareholders around the Canadian operations for mining. So when we look at Drumheller, we look at Medicine Hat, now we have the Validus kind of deal kind of, closing, and we have that North Bay asset. Monetizing energy is, one of the things you're saying here. But if that energy is incredibly volatile and costly, which is a known quantity with Drumheller, with natural gas, peaker plants, that type of thing, what is the path forward when you look at peers that say have, cheap power in Texas? Yes, you're accessing more there, but what really happens to these natural gas sites? Because we know Bitfury's divested from Sarnia in Canada, and they've moved forward with more nuclear. So I guess for me, I'm just trying to understand if you have sites like that, how do you really make them competitive into the halving when you have, arguably higher costs, and how you're going to kind of monetize that effectively for a return on investment?
No, I appreciate the question about me. So I think first, in terms of just like level setting in terms of exposure, today when we think about our sites in Canada that are up online, we have Medicine and Drumheller, and then North Bay that has been offline. Medicine and Drumheller together are a little over 100 megawatts. To put that into perspective, today with the Ionic Managed Services Agreement, we manage over 1,000 megawatts in Texas. So we definitely have a ton of exposure in different energy markets as well. We have sites in New York and Nebraska, and we'll continue to diversify. To answer your question directly, is the issues that HUD 8 faces today are pretty open and people have talked about them. There's an aging fleet, there's some inefficient sites, and there are some operational issues that have existed historically. I think what the board has tasked me with is coming into this business and taking a fresh approach to the issues that exist and how we make the hard decisions to divest, invest, and grow our assets. And so what that means is, and we haven't announced what we're doing specifically, but I can talk to you about kind of frameworks of thinking. So Drumheller, you brought up a good point. That site has some older machines. It has some difficult energy rates because of natural gas prices, and kind of you have elevated energy rates because of that. There could be a world where those energy rates come down potentially, but today they're high. And then you have other sites like Medicine Hat, which are in the same region, but because we have kind of a joint venture PPA there, those high energy rates are actually to our benefit at Medicine Hat and to our detriment at Drumheller. Because at Medicine, we have the ability to mine and sell that power into the grid when power prices are high. So we could actually monetize off that electricity. When I think about sites like Drumheller, we're going to have to make decisions on how we think about the value of those sites and how we think about framing those sites. When I think about kind of miners, older, newer miners, when I think about facilities, investments, the way that I kind of break out that line of thinking is if the idea is let's find the best sites and let's find the best miners all the time, that means all day, every day, you're going to be raising capital, investing in the best and the newest and the brightest. And assuming that you can get that return on your capital, then great. But what are you going to do with your old machine? Are you just going to shut them down? Is there nothing else to do? And so a couple ways of thinking about them, right? Older machines, there are some older machines that the cost of repairing them doesn't is not even worth the return profile on those machines. So you have to make hard decisions at times to say, look, this machine has paid back as much as it can. We've hit our return profiles and our metrics ideally, right? And if that's the case, then we can retire these machines and we don't have to get the market to think that we still want to keep on mining with these machines if they're not operational, we don't want to repair them. On the other hand, if you have machines that can still be effective and efficient, rather than just running the machine and saying, oh, our joules per terahash is 35 joules per terahash, you can underclock these machines at sites where you, even if you underclock it 50%, you can bring that to low 30s, if not high 20s joules per terahash, and make that machine a lot more efficient, right? And that depends on your infrastructure, your abundancy of power, et cetera. And then when you look at power, there are a couple of different sites that you can think about. You have the sites in places with tariff rates like Georgia or Kentucky, where you have a fixed tariff rate and you have pretty stable power, and your only job there is let's run these sites at as high of an uptime as we can to juice as much margin as we can. Alternatively, you can have sites in Texas where you have very volatile energy markets where cost of power can be negative in one interval margin, and then within kind of 30 minutes to an hour, it can spike up to a couple $1,000s a megawatt hour, right? And so your job there is not really about uptime. It's how do you train and monetize around that electricity and create the proper software in order to maximize that value to drive the best return on that asset. And then you have some of the sites where you have kind of stranded power, a wind farm in the middle of nowhere, you're not connected to the grid, and you have really, really cheap power, but the wind doesn't blow all the time. So you're only up 20, 30, 40% of the time, depending on the how new the wind farm is and kind of the technology that exists in the windmills at that time. And so then you can say, okay, maybe I put some of my older machines there that can return a lot of profit when it's running, but I don't care if it's not running because otherwise without this cost of electricity, you're not going to basically have that return profile. And so I hope that helps you understand how we think about the business. It's not a one size fits all. It's about how do you generate the best return profile based on the assets that you have and based on the different generation and cycles of life of where that asset is. how do you still maximize the last last final drops of margin from those, and track how much did we invest into this asset, miners, infrastructure, how much have we returned, and now are we just keep on squeezing to the point of we've already made all of our returns and let's just move forward? Or did we make a ton of money and we're happy, or did we not, and what did we learn from it? So I hope that helps in terms of framework, and decisions that we make, you'll all see, will kind of align with that framework of thinking.
Well, thanks. It clarifies kind of strategy and, like you're saying, like how you rationalize, squeezing everything out of an asset before you realize that it's all been realized and you don't need to run it, which makes sense for certain things potentially in Drumheller, as you've highlighted. I guess just one quick last question is, there's a lot of pivot to AI with a lot of mining companies, Iris Energy, Hive, Applied Digital. To me, it's like a Me Too thing. You're going against the likes of Google, Microsoft, who have like gargantuan amounts of money, scale, size. Do you think that is a strategy that you guys will pursue
Yeah,
as AI, or are you going to stay?
yeah,
Yes.
let me jump in quickly. I think when you think about AI relative to Bitcoin mining, the differences there is you have interesting kind of market dynamics similar to mining in 2021, right? You can't get access to the chips. Everyone's trying to get access. They fund around that access, and allocation is kind of the thing. I'm sure the next phase is who can actually execute, who has the best customer contracts. You're going to have that evolution, that cycle. I think AI isn't interesting because you have to think about it from a cost of capital perspective. Our ability to raise money for an H100 NVIDIA GPU is a lot cheaper cost of capital than our ability to buy a Bitmain ASIC and an S21, right? And so you have to look at what is my return profile and my risk and volatility of that return profile, who's that customer on the other side of the contract relative to my cost of capital. And so the answer is like, is just jumping to AI the answer? No. But are there good investments to make where you have a low cost of capital, a good contract with a strong counterparty that's credit worthy that you can finance against? Yeah, that's a good investment. And if you underwrite it well and you have confidence, then you can raise the capital for it and you can drive shareholder return there. So I think one thing that we're going to deeply, deeply focus on, and look, I'm a big shareholder in this company. My upside is in the shares of this company going up. And so for me, all that matters is, are we driving shareholder return in every investment we make and not following kind of the trend of the day, and figuring out where investors want you to go and kind of understanding where the puck is going.
Okay, and sorry guys, I'm so sorry. Asher's like 7 minutes late for his next meeting. Really appreciate all of you hopping on. Like I said, we're gonna do more of these with other people from the team so you can get to know the new hut better. But thank you so much for coming on, and yeah, we'll talk to you guys soon.